Yo, come here. So what if I told you, that on top of your current income, you could be earning some extra bread from some of your favourite companies for doing absolutely nothing? Yo, calm down. I know that's sick, yeah, but what about if on top of this, the payments increase in value over time? Well, in this video, I'm going to teach you exactly how you can start doing this, so make sure you stick around till the end to hear about some of the best dividend stocks to buy in my opinion. Wagwarn people, welcome back. For those of you who don't already know, my name is Benje. I'm a business owner and a third year university student. Here, I aim to help others by sharing my own struggles, experiences and advice. If you find this video useful in either helping you understand dividends or building your own dividend portfolio, I'd really appreciate if you hit the like button below. And if you ever want to reach out to me, feel free to follow me over on Insta at benje.gs. So I'm assuming that everyone's got at least a basic understanding of what dividend stocks are, but it's calm if you don't, because you can just pause this video right here, go check this one out and then come back. Calm. So now we're on the same page, I'm going to tell you two terms that you're going to want to be familiar with. The first term is dividend aristocrats. These are companies that have increased their dividend year on year for at least 25 years. Brother, that's my whole life plus 4 years minimum. The second term is dividend kings. These are companies that have increased the dividend year on year for at least 50 years. Just to put it into perspective, yeah, that's almost as many years as my queen has been walking this earth. Don't get twisted though, she still don't look a day over 25. Right, so now you know those two terms, let's move on to some pros and cons of dividends. And the biggest pro is probably the reason why you're here. The completely passive income that it can bring you. When you invest into dividend stocks, every so often the company will take some of its profits and pay them to me and you, the shareholders. Different companies pay the dividends at different times of the year, whether this be on a monthly basis, a quarterly basis or a yearly basis, but it's so easy to set up a dividend portfolio that pays you monthly, and I personally have one of these. To get to a point where you can live off your dividends, you're going to need hella bread invested. I'm talking the M's. But this is actually achievable, and this is where pro number 2 comes in: compound returns. Alright, so if you know me, you know I'm all about my drip. I love my crepes, I love my gams, I love all of that. But I'm also all about my drip when it comes to my dividend portfolio. DRIP stands for Dividend Reinvestment Plan, and you're going to want to make sure you've got your drip turned on. This will automatically reinvest any dividends you get paid, allowing growth to build on itself and really have a snowball effect upon your portfolio. The more you invest, the more you get paid in dividends, and the more that gets reinvested. It's all about having that drip and letting that drip work for you. The last pro I'm going to talk about today is that dividends are a good hedge against inflation. Since the 1960s, dividends have grown on average by 5.4% annually, and inflation during the same period has grown on average 4.1% annually. This means that unlike having money in your bank, inflation is not eating away at the value of it. Just to keep it balanced, I like to give the full picture. I'm going to tell you some cons of dividend investing. Con number 1 is that dividends ain't guaranteed by any means. A company can decide to stop paying them whenever they want. Only a couple of years ago did a big company like Disney stop paying theirs. You simply just don't know if a company is going to stop paying a dividend or not, but you're able to reduce the risk of this happening by investing in dividend kings and dividend aristocrats. The second con, and some of you might not even see this as a con, is that you mainly own large blue chip companies. These are companies like Apple that can afford to pay me, you and the rest of the shareholders a dividend instead of reinvesting the profits back into the company for either R&D purposes or growth purposes. This means you often won't see the growth or value appreciation potential as you will with smaller, more speculative and growth stocks. This is why I say it's always so important to be diversified and own many different types of stocks based off your own life goals, your investment goals, and the risk you're willing to take. If you want to know what type of investments take up what percentages in my stock portfolio, be sure to check out this video. The last column I talk about today is even if the company continues to pay a dividend, the stock price may fall. This means that the overall value of your investment will fall, but you'll often find that the price of these blue chip companies often steadily increases over time. So let's say after hearing all this, you're like, yeah, calm Benji, I want to start my own dividend stock portfolio, but how may I do this? Well, there are a few key things that I like to look out for when choosing my dividend stocks. Firstly is that they have a history of paying a dividend. You don't want to invest in a company who are just going to suddenly stop paying a dividend as soon as you've put your money in. This happened to me at the beginning of this year with a company, but luckily the stock price rose and so I was able to sell it for a profit anyway. You can find out the length of time a company has been paying a dividend and how long it's been increasing on Google. You can also take a look at all the lists of the dividend aristocrats and kings. The second thing is dividend yield. A yield is just a dividend as a percentage of the share price. A company like Apple pays a dividend of 82 cents a year, which is equivalent to a yield of 0.68%. In basic terms, if you invested a bag into Apple, you get 0.68% of that back every year in dividends. One of the biggest things to note is that high yields do not necessarily mean the best investments. Apple has a hella low yield, but am I ever going to take them out of my dividend portfolio? No. You have to think about the total performance of a stock and a company when choosing dividend stocks, just like with any other investment. Often, if a company pays an overly high dividend yield, it means that they aren't reinvesting profits back into the company to try and grow. Another key thing to look at is a dividend payout ratio. This is simply represented by the amount paid in dividends divided by the company's net income. So let's say that a company makes $1 million profit and is paying a dividend of 500 bags. This would mean that they have a payout ratio of 50%. The higher the payout ratio, the less being reinvested back into the company, as the majority of the money is going to shareholders like me and you. Companies with high payout ratios often find that their capacity for growth is stunted because they just don't have the capital available to invest in development. The payout ratio can be used in conjunction with other things to be able to assess whether a dividend is sustainable in the long run. The last key thing with your dividend portfolio, and as I say with every single type of investment, is diversification. At the time of recording this video, in my current dividend portfolio, I've got 21 different stocks, all operating in different sectors and industries. By doing this, I and you will be able to reduce the volatility of our portfolio and also spread the risk over many different industries. Right, so now onto a couple of my favorite dividend stocks that I own. The first one I want to talk about is 3M. They currently trade at around $190 and have a dividend yield of 3.12% and a payout ratio of 63.57%. They pay their dividends quarterly, and the stock has seen steady growth since the onset of the pandemic last March. They have a healthy profit margin of 16.73% and is a dividend king, having increased the annual dividend for 62 consecutive years. Another of my favourites is Realty Income. They literally call themselves the monthly dividend company, and that's one of the reasons I love it. I get paid monthly. The stock price is currently trading at around $63 with a dividend yield of 4.51%. They have a payout ratio of 245.7%, and while that seems unsustainable, due to them being in the real estate sector, they're able to write off depreciation, and some REITs even report negative earnings. When looking at a REIT, there are better metrics like FFO and AFFO to consider. Just remember that this ain't financial advice, but dividend stocks are some of my favourite stocks to invest in, and I'll be continuing to invest until I can hopefully live off the dividends and beyond. If you'd like to learn about what crypto I have and how you can start investing, be sure to check out this video. Love to everyone who's watched this far, and we will see you again soon.